Everybody, it is St. Patrick's Day. Have a great day to remember, or don't. It's totally fine, whatever you do. Thank you, everybody, for joining me. This is weird. I haven't shaved. This is growing. This is not growing. And if I keep this up, I'm going to end up looking like Pedro from Napoleon Dynamite. And I don't think anybody wants that. All right. Let's dive right into this because, eh, you know, markets are going to market, man. Here we go. March 17th. Lower highs, lower lows. That's the trend that we keep talking about. And I keep saying the purpose of a market is to sell, live it, know it, love it. Structural sell off since the war began. $70 billion CTAs are set to dump this week, according to Goldman Sachs. Does that number mean that it's really true? I don't know. But it does sound like a lot of selling. We had a 1% bounce. That didn't change anything. And guys, I keep saying to you over and over again, focus on volume weighted average price. Look for these reversions, look for these bounces. And what happens is we end up in this situation where we have relatively quiet days, just a straight burn higher. A little bit of profit taking comes toward the end of the day. And funds use any short-term strength in order to unload positions. And once again, the market does not go straight down. It is a period of a stair-step pattern. Lower highs, lower lows, lower highs, lower lows. Brent is back above 103 this morning because why not? We're only 5% off from the highs, but we have plenty of room to move lower. I walked you through all of the different challenges that this market is facing. And the Federal Reserve is providing ample monetary support. The Bank of Japan is providing ample monetary support. China is printing money. So, yes, all the people who are hyper bearish, I'm just going to remind you, monetary policy sets the floor. And the question is, what happens if funds start to sell aggressively? We're not there yet. 5% off of all-time highs, despite all of the turmoil that we have. Liberation Day retraced 61% of the move from November 2023. That level is much, much lower. The carry trade and the basis trade unwind risk still exist. We have to pay attention to what the Bank of Japan is doing. I know that you guys aren't watching the Bank of Japan, and who is? But you know what? Their baseball team lost the other day. They're looking for something to do. Maybe they're going to print money. The big thing around gold, a lot of people have asked questions about gold prices. It's been around 5,000. The fact is, all of these central banks around the world have been buying gold since we took Russia off of our reserves. That happened after they invaded Ukraine. That was the weaponization of the United States dollar. Since then, central banks have been loading up on gold. But here's the problem. If oil prices move higher and they have to subsidize oil or they have to buy it at a national level, well, they're not doing it in dollars anymore. They have to sell gold potentially to buy oil. And this is one of the things in the great currency war between the United States and China that has been transpiring for about a decade. This could put a significant amount of pressure on them. The United States, largest producer of oil in the world, top exporter. Oil is a weapon. Oil is a strategic asset in a battle of currencies. And if they are selling gold in order to purchase oil, obviously gold prices can move lower. That's one of the big questions people keep asking. They say, we don't understand how the war is going on and gold prices are moving lower. It's because nations don't have dollars to sell. They have gold to sell in order to purchase oil. And any selling creates pressure on the market. That is the cleanest explanation for why gold prices are not at 6,000, 7,000, 9,000. Just pointing that out. Jerome Powell, tomorrow, will speak. He's going to wear a beautiful tie. He's going to say the most boring things you've ever heard in your lifetime, but the Federal Reserve is not going to cut interest rates tomorrow. Don't worry about that. The big question around the Fed is the forward guidance. What are they going to say about the job market? What are they going to say about inflation? Now, once again, I don't care what the Fed does or what the Fed says. Forgive me. I care about what the Fed does. I barely listen to the man. But the key thing to keep in mind is the Fed funds rate does not matter as much anymore. It is the SOFR rate that we have to be paying attention to, the secured overnight financing rate. If that is spiking above Fed funds rate, that is creating a liquidity issue in the financial system, and that can lead to a race to cash. The FNGD, which we talk about on a regular basis, is still on an uptrend. The MACD is still crossing positive. The FAZ, which is the inverse ETF for banks, triple ETF, is in an uptrend as well, showcasing the problems around private equity, private credit, and of course, regional banks during tax season. We are stuck between two fires, and this is really what the Fed predicament is all about. They need to cut. I think the president's not wrong. We should start this process of cutting interest rates just to signal to the market that we care. But the reality is we can't. We have a weak labor market. Our financial system is showing cracks. That is evident in our reading that we have over at Capital Wave. Let's take a look at that real quick just so that you can see how much pressure there is in the regional banking space. You are a member of Money Printer Pro. I get this wrong all the time. I'm going to mispronounce my own product constantly. I want to say Money Map Press. That is just a decade of just, okay. You see the regional banks that are on this list. You see Fifth Third Bank. You see HBAN. HBAN had a huge insider buy. This is one of Tim Melvin's favorite banks, but it's still in breakdown mode. And I want you to remember, when you go over to this website or you go to moneyprinterpro.com, which is now live, so you don't have to type my name in. You can just type in. Look at that. Oh, my gosh. We are like two horses just pulling a chain right now. Look at that. Oh, my gosh. That is fantastic. Fifth Third Bank is on that list. You see KKR, you see Franklin Services, U.S. Bancorp, Citizens Financial. This is all regional banking. Huntington Bancshares, big insider buy. I'm not going to touch any of these names until two things happen. One, they've got to come off this list. But secondly, I need the central bank to actually step in and give a damn. They're not doing that right now, which means there is likely going to be more weakness moving forward. KeyCorp, good company. Day 5. Here's the beauty of it all. Oh, let's go back to that guy. KeyCorp, okay? Remember, look at the numbers on this list. See that 5-day, 5-day, 5-day? 5 days KeyCorp has been on this list, and it has been a short, right? Using options, using spreads, looking for the continuation of trend to the downside. I'm going to do a whole series, how to trade this stuff. Guys, I'm going to tell you, this is momentum. This is upside, downside momentum. This is where you want to use spreads. You want to buy call spreads, and you want to buy put spreads. And you keep tight stops. I'm going to just simply note that momentum is a great way to trade because this is not where all of the pricing is quote unquote priced in. You look for a continuation of downtrend. Look at General Mills, GIS, right? 12 days in negative momentum, $4 or $5 move. And this is the thing where if you're trading it, you set a 10 to 15% stop. But if it breaks down and you time this the right way, if you're fortunate enough that the trend continues, and you have to put it that way, it has to continue to break down. But the point is, a good spread can lead to 215 to 300% gains. Tight stop to the downside if you are under pressure, and you set the numbers for yourself up as you use Option Profit Calculator. Or Options Calculator by Garrett Baldwin, everybody. moneyprinterpro.com/optioncalc. That's a good time. All right, let's keep digging into other things going in with the market. So as I noted, We're stuck between these two fires. Inflation's about to worsen with the oil shock. We're going to see pressure during that new CPI number, the PCE number, when that comes out. End of the month, 20% chance of a hike now in December. I mean, this is significant. The idea that we're talking about interest rate hikes. That's what this meeting is going to be about. And the fact that members of the central bank are likely going to continue to debate this, that dot plot that is going to be released tomorrow is probably going to showcase that at least one or two members of the FOMC wants to raise rates. We need to cut rates, but at the same time, we need to raise rates. That's very difficult to actually wrap your mind around because inflation remains a challenge, but at the same time, the fact that oil prices are higher and that goes into the cost of virtually everything, that's a challenge. And keep in mind, politicalization, I got it right. Forgive me. Politicalization of interest rate policy. We haven't seen a president as absorbed on what the Federal Reserve is doing since Lyndon B. Johnson. These are all going to lead to massive overreactions by the equity market and in time lead us to a place where we're going to see likely more volatility. Just be cautious, follow the reading, follow the numbers. Right now, we are in negative momentum. We have been in negative momentum since January 28th. Key headlines, obviously, Brent at 103. Cruise lines are squeezed. Oh, no. Poor Shaquille O'Neal. What's he going to do? Who's the other guy? He was in The Office. He's doing Carnival Cruise Line ads now. Can't have that. Hope he was not paid in stock. Trump has delayed his China trip. He pushed that back to the 31st. I didn't even know that March had a 31st, but that does make sense. April only has a 30th, and February only has 28 days, unless it is the 29th every 4 years. Look at me. That education in elementary school is paying off right now. $1 billion coal plant Terra Energy committing 1.25 gigawatts coal in Alaska because it's not warm there. The first new U.S. coal investment in over a decade. I'm loving it. Love to see the new commitment to coal. Love to see that we're putting a new refinery here in the United States. These are things that are necessary moving forward for us to continue to grow our economy. Electricity, we cannot afford our electricity costs to get out of hand like what is happening in Europe. We have a pre-Fed drift. That's what we should be focusing on. We were minus 49 yesterday on our S&P 500 reading. Minus 49 has now moved to 40. We've seen the Russell improve as well. Guys, this is really about following the trend of short duration, using volume-weighted average price, buying over the line, selling under the line. Not a whole lot really to expect in the next 48 hours. I really do wonder what it is that Powell could say that would set sentiment higher outside of printing money. They're probably not going to do that. Energy is still our only positive sector right now. Financials, industrials, consumer cyclicals, all deeply negative. That's why your cruise line stocks aren't doing well. Cruise line stocks are heavy momentum stocks. Norwegian, CCL, which is Carnival. There's another one. Forgot. Oh, well. NASDAQ divergence flashed Monday. Very important to keep this in mind. If you look at the S&P 500 right now, only 31% of stocks are above their 50-day moving average. This is an extremely weak market. 200-day moving average, only 42% of stocks are above that 200-day moving average. And right now, as we move into today, new highs, new lows, basically even. 47 stocks have hit new highs today for 52-week, 42 stocks hitting new lows. There really is no momentum in insider buying, and this is telling me something very important. There's no policy change coming. And I want to stress this. So people who are sitting out there saying it's a great time to buy, the markets only go up over the long term, they're stuck in this pattern right now. This is a 2-month, 3-month process. The insider buying to selling ratio is now 1 to 63. Insiders are not buying. Executives are not buying their stocks. CEOs, CFOs, 10% members of their board, they're not buying. So my point is always the same. If executives aren't buying their own stock, why are you? Go to insiderstockbuys.com, type in guest at insiderstockbuys.com as your sign in, capital G, guest 2026. You can check it out free, look at it for the full week. We're going to start to gate that relatively soon. But you can see that insiders are not stepping up. And even in the world of aggressive purchasing around BDCs, which are business development corporations, that's been aggressive, but there really is no sign right now that there is going to be political accommodation across the financial sector. That's probably going to come later this year. So I want you to look at who is buying. I want you to write down right now, what are they buying? What is the price they're paying? And then what we can start to do is assess what's the optimal way to enter these positions. Do you sell put spreads? Do you only buy when the 8-day moving average moves above the 20-day moving average? Or do you find companies that are extremely capital efficient that can lead to significant upside with time? I want to see a positive move in policy before I start aggressively purchasing business development corporations and regional banks. And I'm speaking of this with sincerity in my heart. I want to be able to buy regional banks and BDCs. I like the fact that they kick off the cash they do, but we're not having a policy accommodation yet. So there's still downside here. It might be 10%, it might be 20%. But if we get to these levels, remember, the executives who are buying right now, they're buying cash flow. They're happy to wait this process out. They know that if they're buying something at 20 and it's paying 11%, they're going to get 11% over the next 18 months. The stock might go to 15, it might go to 10. But eventually there's going to be a policy accommodation that's going to lift these stocks higher. I prefer to wait for the policy accommodation and for the insider buying to selling ratio to pick up before I start to push my cash across the table. The inflation growth flip. For 2 weeks, yields climbed on inflation fear. Now, bigger shops are positioning for what comes after, and that is a growth shock that historically follows the energy shock. Besson's saying U.S. is allowing Iranian tankers through, or oil briefly at the $94 level, yields effectively at 4.2%, but the Straits still mined, escorts haven't materialized, and the Iranians hit a United Arab Emirates oil hub on Monday. Every serious U.S. downturn in 50 years was preceded by an oil spike. Yes. I want you to sit with that. Every major U.S. downturn in 50 years was preceded by an oil spike, especially that 1990 downturn that cost George Bush won the presidency. The world changed because of that war. And so did modern finance. At some point, the inflation trade flips to the growth trade. We'll get there, I promise you. I want to see insiders buy first, and I want to see policy accommodation as well. That's it for me. I got to wrap it up. The real bottom doesn't come until something breaks. Like, it's got to snap. We have to start seeing 2% days. We're not there yet. The Federal Reserve is still pumping $40 billion a month, upwards of $55 billion a month into the system itself. And it's still not enough. My expectation is there's going to be something bigger soon, but we're not there yet. And the insiders will tell us where we are. I'm going to tell you to spend your day. It's St. Patrick's Day. You don't need to be in front of your computer today. Go have a good time. Go enjoy your day. Don't try to trade today. Tomorrow, the Fed's going to meet. That's going to be an important meeting. But at the end of the day, there's no reason to spend your time in front of a computer today. Go do something. Pick up a hobby. Do something different. I'm leaving. I'm going to go swimming in 20 minutes. As always, if you have questions, send me a note. Just reply to this email or put it in the chat. More than happy to answer your questions. I appreciate the fact that you get up each morning, have your coffee or your tea, and you listen to the ramblings of this nuck. But at the end of the day, look, this is going to be a difficult week for markets. We have triple witching. No, it's quad witching. Quad witching on Friday. And we'll move further through this. We're not there yet. We're not on the other side. And people have been asking questions, where do I put cash? I think there's opportunity that's going to exist in 2 to 3 year bonds in the investment grade level. And we'll have to parse through that. I have to spend a little bit of time doing that research, but I will come up with a list of names. We'll be looking for 3, 4, 5, 6% gains with bonds. And then when it is time to unload those bonds and to go back into those high beta stocks because the liquidity cycle has reset, we'll all be better for it. I hope you all have a wonderful day. Thank you so much. I'm going to go shave. Take care. Stay positive.